What is an index fund? The U.S. Securities and Exchange Commission defines an index fund as the following: a type of mutual fund or unit investment trust whose investment objective typically is to achieve approximately the same return as a particular market index, such as the S&P 500 Composite Stock Price Index, the Russell 2000 Index, or the Wilshire 5000 Total Market Index. What are the differences between index funds and other mutual funds? The first is limits. An index fund is limited to the stocks and bonds within the index it tracks. Most traditional mutual funds have more options available to them, but this is not always true. The second is management. The vast majority of index funds are passively managed. Since few, if any, investing decisions need to be made, most index funds don't require active management. The lack of active management allows index funds to have much lower costs. And the third, risk. The risk of an index fund is similar to the risk in the corresponding index. Traditional mutual funds can control how much risk is in the portfolio. Since an index fund effectively owns the stocks or bonds within that index, the risks are nearly identical. Index funds are a specific type of mutual fund. An index fund is usually managed passively and is limited to investment options within the index it tracks. Being passively managed results in lower expenses.